We've got Sunil Subramaniam, who is now joining in. He is MD and CEO, of course, of Sundaram Mutual. And Sunil, I'm going to start off with February 1st, the budget, and lots riding, because as of now, it's no ordinary macroeconomic backdrop that we're seeing at a time when GDP growth is low, fiscally as well. There is little elbow room. Tax collection has been fairly modest. What are you going in with in terms of your wish list or your expectations?
So first of all, I think that the fiscal being stretched is this year phenomenon. The budget is going to talk about next year's fiscal spending from that. So I think there, I don't think it's going to be an issue. I think in the new year, government will naturally project much higher GST collections. Again, a very ambitious disinvestment, because the point is that this year's gone and done and dusted. So there will be a report card presented of this year, which may not present a very happy story, but you will see a government laying out a expenditure plan for next year, which will depend on the tax collections next year, on whether it gets implemented. But today we're going to trade on the promise that that's going to happen. And the market, given the liquidity surplus that's there, is going to bet on that promise. So I would expect market to touch new lifetime highs post the budget, because there will be one thing with this government you notice is that they don't wait for the budget to make the major announcements.
Right.
They've done a lot, like a corporate tax cut, like the infra push, all in the run-up to the budget. So I think the budget is going to be more about, I would say, NBFC banking reform.
Okay.
Right? It's going to be more about how employment generations, right? Whatever they're going to do to ease the land reform, labor reform situation. So I think the budget is going to be touching on those kind of things rather than on any things like a corporate tax giveaway or whatever. That's already done and dusted. On the direct taxes piece, right? I think that rather than do a direct income tax cut, they might tinker with LTCG, because I think disinvestment being high on the agenda, and the fact that LTCG has not proved to be the windfall in terms of inflows. And this government has proved one thing, right? One, they are generally late in reacting, but when they react strongly. But more importantly, they are not hesitant to reverse unpopular decisions. So I think that the LTCG move in itself proved to be a sharp up move for the markets. And I think there's no cause for not happening. That's, I think, the positive that I look at the budget is that they finally come to terms with the reality of the fact that Mr. Modi talked about how wealth creators he wants to actually encourage and support.
Right.
But LTCG is actually an anti of that. So I'm hopeful that they will do something on the LTCG, at least push it to a 3-year, 5-year kind of a...
I think that's the last remaining thing on everyone's wish list, the LTCG. But, with the latest inflation figures coming out as well, I mean, we're continuing to also see more and more evidence that for them having the room to really push on the fiscal front is going to be incredibly challenging. And I think that's really what the markets will also watch out for, don't you think?
No, I don't agree with that. Because I think that if you look at two things, that from a rating perspective, we are the borderline of investment grade.
Okay.
So one of the reasons we can't afford to spend too much is the worry with the rating agency.
Sure.
But at the same time, you look at the quality of the expenditure of the government. Right, I would say the quality is pretty healthy. Because the corporate tax giveaway, infrastructure spend. I don't think this government is a profligate government in terms of giving farm loan waivers, Narega. So I think the quality of the expenditure is good. And I think the rating agencies will be far more tolerant of what you're spending for, because the rating is ultimately dependent on growth and that scenario. So I'm not very sure that what you're talking about, the fisc stretch, and I think she also mentioned it. Right, I think that there's too much. The market is already looking beyond that.
Sure.
This year is done and dusted. Everybody know what's happened this year. Tax collection haven't happened. Government has given away 1.5 lakh crores of tax giveaway. That's fine. But you have a next year new budget. And you have, even if you project a 15% growth in tax revenues, right, you're going to have enormous room to spend. So I think that the budget is one of hope and optimism. And that's, I think, what the market is also looking for. Everybody knows the bad news. Everybody knows the thing. All they want from the finance minister is to say, this is a roadmap ahead. These are the steps we are taking, and they don't mind if they're a little rich on the inflow part in order to fit in the mega plan on the expenditure part. And I'm saying the market is ready to cut that slack to the government today.
If you don't get a LTCG extension, if you don't get a change of definition of dividend distribution tax, if there is no large meaningful cut on personal tax, which is what ideally it should come, but if it does not come, and if government says, look, we'll cross the fiscal mark, but we'll not bust it. It will remain in and around 4%. And if they give an ambitious target for disinvestment for this year, I mean, if they do things which markets don't want, then could things really turn ugly in the short term?
Again, like I said, Nico, I think what happens is that the market is flush with liquidity, and there's no room for negativity when you have money in your hands.
No room for negativity, which means bad news also comes out, it will be discounted.
It will be treated as saying that the news is out in the domain, the future is going to look good. Consistently, the market has been doing that. In fact, over the last 3-6 months, what's happening? You're actually seeing the small caps and the mid caps rally without even an economic slowdown. Why? Because the market firmly believes that, once something is out in the public domain, that's history. Right. It's like the autopsy of a body. Yeah. Right? What you're looking for is the future. And I think that the market already is aware of this news. I don't think there's any surprise in bad news. And I think one of the key things which I do expect to happen is the NBFC reform. I think the government could announce some very strong steps in terms of maybe giving a quasi-bank status to some of the larger good quality NBFCs so that their cost of funding and everything increase. Because the PSU banks are going to take a bit of time. The mergers have been announced. Yeah. But it's going to probably the whole of 2020 it's a kind of write-off from a PSU bank coming onto the lending perspective. So I would say that the government very keen to make sure that enough money is available to restart the reform. Will look at good quality NBFCs actually kind of getting the repo window, kind of getting cheaper cost of money. So I think that's the one reform which they haven't yet really tackled. See, post ILFS crisis, really seriously, they haven't yet tackled the NBFC crisis, if at all, I would say. And that's probably one thing that the budget could...
Sunil, I'm again just looking at historical data. The historical data is the following. Gold and Nifty have given the same returns in last decade.
Correct.
Small cap index, or the small cap is worse. Mid cap index and the Nifty have given the same return. Now my question is that if somebody is buying gold, you would say, look, I don't have to bother about the headlines. I don't have to look at the ticker every day. I don't have to make a view on what is going to happen in the world. I simply buy the gold. I can buy electronic form or physical form. And I'm making a good return, which is risk-free return. If I'm buying mid and small cap stocks, I always have this feeling at the bottom of my tummy. This will go right, that will go right. So the lower you go on in terms of risk, the better the returns have been. How ironical is that?
The reason it's ironic, and I think in the last show also we touched this point, is because you're looking at a point in time when risk has been punished. Whenever you look at it in a cycle and the risk has been punished, you'll always find that safety has delivered better returns than risk. But in a time when risk is being rewarded, it'll leave these traits behind. So I think it's entirely with what lenses you're viewing the market. At the point when risk is being punished, everything will look bad. And when there is liquidity combined with risk being punished, naturally safety will get a higher thing. But you go forward, and if you believe that growth is going to come back, right, automatically, I guarantee you 3 years from now, you'll say, why did I bother to put money in gold? Because when risk is being rewarded, so gold as a safety hedge actually delivers the return best when the market, when the whole industry and the market and the inflation and everything is uncertain, right? So it is a safety hedge. And unfortunately, the way liquidity works is that in a time of high riskiness, safety actually gets a lot of money because lots of behavioral thing says, let me not take a risk, let me not take a risk. So it's just the pools of money reallocate, and it won't take very long to reallocate as long as growth is visible in the agenda. I think.
So my next question would be, equities will always give you superior returns. We can always look at data and slice and dice and make it look different. But it is important to identify the high growth business.
High growth business.
High growth business in 20s was technology and media and telecom. The high growth business in last 5 years was consumer and some NBFCs and retail dominated balance sheets.
Yes.
I don't know 10 years, but we can perhaps try and predict the world for next 3 to 5 years. For next 3 to 5 years, which could be the outsized gainer in the equity market, and what would be the high growth sector, company or clan?
So I think the next 3 to 5 years is going to see the huge shift of manufacturing from China to India.
Okay.
And I just give you some sense of the numbers. $540 billion is America's imports from China. $54 billion is India's imports from China. China is losing 21 million people from its workforce in the next decade. India is adding 117 million people to its workforce. China has at a per capita income of $10,000, which is per capita wages equivalent. India is at $2,000. So cost of labor, supply of labor, as well as the fact that Chinese companies, I was just stunned to read this data. Last 3 years, Chinese companies have invested $25 billion FDI in India. And this number is expected to double over the next. So what I'm trying to say is even Chinese companies themselves are looking to shift their manufacturing. So that $550 billion export pool of China is ripe for the taking, even by Chinese companies taking advantage of Indian reforms. So over the next 3 to 5 years, what is going to happen when they come in? They need to set up factories. They need to set up plant and machinery. So the suppliers to this, the cement, the steel, the capital goods suppliers are going to be. And over the last 3 years, they have been punished. So today you have in a sweet spot that their valuations are reasonable and the future growth prospects are high. So I would say that infra-related funds and small cap-related funds, because small cap index has about 40% into infra and capital goods related stocks. So either you choose small cap or you choose infra as a bucket, right? You are going to see quadruple your 10 rupee NAV will be going to be 40 rupees, in my guess, in 5 years' time. So that's going to be the next big multi-bagger.
I saw an article in newspaper a couple of days ago that somebody has made a building by 3D printing. A Dubai building has been made. Now that building, I don't know how much steel or cement has been used. If that is the way manufacturing, I've not read it, but I'm just saying that the way manufacturing has been done in the past, if that changes, then are we going to see a big change in technology adoption, cement consumption, steel usage? If the old school style of construction and activity changes because of the kind of world we are in, will markets say, look, these businesses are important, but you'll never value them? I mean, utilities, they're cheap and they'll remain cheap.
So my question here is that even if you do 3D printing, you still need cement and concrete to build that building. It's only the imaging and the execution that's happening, right? You still need basic building blocks. You're not going to build a building in plastic. One. Two is that the technology versus people debate, I think in India, is just the sheer supply of labor is going to make using labor that much cheaper than technology. So we're going to delay that process. I agree that it's an inevitable process of technology, but India is going to be that country which is going to hurl back this world's advance, because we're going to have high-skilled English-speaking labor available at very reasonable rates, right? And I think end of the day, cost drives the world economics, and it is always about produce where it's cheapest, sell where it's most expensive. So I think that despite all that you say, I would still say that the infra cap goods and the small cap broader supplier to capital goods. I'm still not talking about India becoming a manufacturing capital and that coming to. I'm talking about the whole building up of the capacity, not from an Indian demand perspective, but to satisfy the substitute what China is already doing to the world. And if there's any news of the world recovery coming faster, that is going to give this a further upshot. Today, just the substitution effect is going to drive, the businesses here. So I think that, from that, if you ask me, the multi-bagger segment is that. Your small cap and your infra-related funds.
Okay. Yeah, interestingly, this building was built in 17 days, and there was a mixture of cement and building materials.
I don't know. I just read. I read the headline, but just think about it. Just think about it. That what will happen to.
This is the future.
What will happen to labor? What will happen to the way how technology would move? This is a disruptive trend. And disruptive trend is something which we need to keep our eyes and ears open for. Well, appreciate your time. Thank you for joining us.
Thank you.
And